What do you mean by 5% down? There's a specific product with CMHC MLI Select. I think
Yes.
that's called MLI Select, right?
Yes.
So can you explain that?
Yeah. So CMHC, even prior to MLI Select, offered insured multifamily mortgages.
Okay.
CMHC standard.
Okay.
It was, a function of do you debt service?
Okay.
And you'd probably get the loan, right? Maximum 85% loan to value. So they would fund up to 85% of the value of the building.
Okay.
Now, MLI Select came along, which, I've heard people call it the Lamborghini of mortgage financing.
Interesting term.
Yeah. I didn't come up with it. I've heard it from others. But what it introduced was a point system.
Okay.
Where you score points in 3 buckets.
Okay.
Affordability, energy efficiency, and accessibility.
Okay.
Now, you don't need to score points in each bucket.
Okay.
Each bucket, the points allocation is different.
Okay.
Now, what that enables is different terms. So, for example, on a CMHC standard, on an existing building, the maximum amortization you could get on a loan is 40 years.
Okay.
MLI Select, you can get up to 50 years depending on the number of points that you get. As well as, CMHC standard, you would get max 85% loan to value on your loan. MLI Select, you can get up to, based on the number of points, 95% loan to value. Now, there's other perks, insurance premium savings, and all of this fun stuff. But that was the biggest difference when MLI Select came along, is you had an option now to get cheaper insurance premiums, lower DCR requirements, more aggressive loan to value approvals, if you met certain criteria. Now, over time, those criteria have gotten stricter and stricter. So, for example, a year, 2 years ago, I lose track of the dates now, you could have probably gotten 100 points, so full benefits with just energy efficiency points.
Okay.
They've scaled that back now where you can only get 50 points with energy efficiency. As recently as a couple months ago, they've actually made energy efficiency on new construction even harder to get.
Okay.
And really driving the developer or investor to have to commit to affordability.
Okay.
Indirectly, like they're not saying you have to, but the way they're shuffling the points, they're shifting that consumer behavior quite a bit.
So is it discouraging investors?
I'd say it has discouraged a big pool of investors for sure. So, one of the recent changes is the energy requirements. So now, the percent that you need to be above building code has increased drastically depending on what you're building. Which now obviously has a bottom line impact to your cost, right? So that's turned off a lot of investors, especially investors who had development projects in their pipeline. Now, in a 4+1 6-plex type project, while its cost impact, it may not be huge, but you could imagine if now the percent, above building code increases by 30% now across 183 unit development, you can imagine what the cost impact is going to be.
Yeah.
And then it's really shifted people to have to do affordability, if they want to get 95% loan to value, if they want to get, 50-year amortization. So it definitely turns some people off. Now, on the flip side, there's a lot of people who've learned how to navigate the system. They understand the game. They understand that it's still better financing than anything else on the market.
Okay.
So, if you have the capital to play the game, it's still the most attractive financing tool out there, in my opinion.